Hello friends. From non-returning Indian to non-responsible Indian to nerve-wracking Indian, the term NRI has run a gamut of meanings, none of them very complimentary though. When the first Indians set out in a significant organized way to make a living abroad in the 19th century, few had imagined that they would come to have a profound influence on India. Not even when India's most famous NRI, Mahatma Gandhi, returned home after 21 years in South Africa to lead India to freedom was the role of the NRI in domestic affairs acknowledged. So having said that, I welcome you all to another video on understanding foreign remittances where we will learn about LRS, which is Liberalized Remittance Scheme, and the tax implications involved in transfer of funds abroad under LRS scheme. So I welcome you all to my channel Financial Fitness with CA Ashima Abel Yunus. The Reserve Bank of India introduced the LRS scheme known as Liberalized Remittance Scheme to facilitate hassle-free foreign exchange. For those who move abroad or send their children abroad, there may be times when you need to transfer funds from India to the country where you or your children reside. Or there could be instances of foreign tour packages providing loans or sending gifts to relatives living abroad. In my previous video relating to repatriation of funds, I explained different ways of repatriation of funds and have covered a few points regarding LRS as well. And in this video, we will look into some more FAQs on LRS. The points that I'm going to cover in this video are availability of LRS, what are the limits under LRS, are there any restrictions on the frequency of the remittances, tax implications under LRS, tax on overseas investments made through LRS, what are the items prohibited under the LRS scheme, and what are the purposes for which a resident individual can avail of foreign exchange facility under LRS. There are some questions that comes to mind like can remittances be made only in US dollars? And is AD, which is the authorized dealer bank, required to check permissibility of remittances based on the nature of transaction, or can they allow the same based on remitter's declaration? And some other FAQs. So make sure you watch this video to the end so that you don't miss on any part of the information shared in this video. But before we begin, I would request you all to subscribe to my YouTube channel. It's totally free. You can just log in on YouTube with your email ID and click on the subscribe icon and share it with your family and friends. You can also share it in the WhatsApp groups in your phones. I will just take a quick pause only for 5 seconds so you all can take time to click on the subscribe icon, like icon, and also click on the bell icon that you will find below this video. Please do that while I wait for just 5 seconds. Okay, so now I'll quickly introduce myself for the new viewers. I am CA Ashima, a professionally qualified chartered accountant, a certified auditor, and a certified ERP implementation specialist specializing in tax, finance, IT, and audits. I have worked as a partner and a director with one of the top 25 leading CA firms in India, which has also been a member firm of one of the big fours. After working in India for a period of 10 years, I moved to Sweden and have also worked as a senior financial consultant with a multinational and have catered to corporate clients in Sweden, Finland, Norway, Denmark, and the UK. I have also worked as a freelance financial consultant. Now let's understand what is Liberalized Remittance Scheme. So first I will brief you all about what is LRS. Under LRS scheme, all resident individuals, including minors, are allowed to freely remit up to an amount equivalent to 250,000 US dollars, which is 250,000 US dollars per financial year. Financial year starts from April and it goes until March for any permissible current or capital account transaction or a combination of both. In case of remitter being a minor, the LRS declaration form must be countersigned by the minor's natural guardian. The scheme is not available to corporates, partnership firms, HUF, trust, etc., and is only available to resident individuals, including minors. We may sometimes think whether there are any restrictions on the frequency of remittances. So, there are no restrictions on the frequency of remittances under LRS. However, the total amount of foreign exchange purchased from or remitted through all sources in India during a financial year should be within the cumulative limit of 250,000 US dollars. Once a remittance is made for an amount up to 250,000 US dollars during a financial year, a resident individual would not be eligible to make any further remittances under this scheme, even if the proceeds of the investments have been brought back into the country. Now let's understand the tax implications on remittances made under LRS. There shall be no TCS, which is tax collected at source, on expenditures under LRS for the first rupees 7 lakhs, irrespective of the purpose. Under the LRS scheme, you are liable to pay a 5% tax collected at source only for remittances exceeding the limit of rupees 7 lakhs. However, you can claim a refund for the deducted TCS while filing your ITR using Form 26AS, just like you claim TDS, which is tax deducted at source, while filing your income tax return. Budget 2023 had raised TCS rate on foreign remittances through LRS scheme to 20% from the existing 5%, except in certain cases. The increase in the TCS rates to 20%, which were to come into effect from 1st July 2023, shall now come into effect from 1st October 2023. So up to 30th September, the TCS rate of 5% will be applied on remittances exceeding rupees 7 lakhs. But with effect from 1st October 2023, TCS rate of 5% will increase to 20% on remittances exceeding rupees 7 lakhs. So here comes one tip which may be used when you are on a foreign tour package in order to save on TCS. If you are using international credit cards while being overseas, then these expenses will not be covered under LRS and hence no TCS will be applied. Now let's look into tax on profits from overseas investments. Profits gained from overseas investments made through LRS are taxable in India, depending on the investment's holding period. Profits on investments held over 2 years are considered long-term capital gains and impose a tax of 20% on the total profit earned. Profits earned from investments sold within 2 years are taxed at normal income tax slab rates. Now let's look into the prohibited items. The remittance facility under the LRS scheme is not available for any purpose specifically prohibited under Schedule 1, like purchase of lottery tickets, sweepstakes, prescribed magazines, etc., or any other item restricted under Schedule 2 of FEMA rules. Remittances from India for margins or margin calls to overseas exchanges, overseas counterparty, remittances for purchase of FCCBs, which are foreign currency convertible bonds issued by Indian companies in the overseas secondary market. Remittances for trading in foreign exchange abroad, which means you can invest in stock market by buying shares of a foreign company, but you cannot sell them on the same day like you do in an intraday transaction in India. So you need to get the delivery of those shares in your Demat account, and of course, you can sell those shares on any other day other than the day when you bought them. Then there are capital account remittances directly or indirectly to countries identified by FATF, which is the Financial Action Task Force, as non-cooperative countries and territories from time to time, which are also prohibited. Remittances directly or indirectly to those individuals and entities identified as posing significant risk of committing acts of terrorism as advised separately by the RBI to all other banks. Another prohibited remittance is gifting by a resident to another resident in foreign currency for the credit of that another's foreign currency account held abroad. Now let's look into the permitted items. Let's look into what are the purposes under FEMA under which a resident individual can avail of foreign exchange facility. Individuals can avail of foreign exchange facility for private visits to any country except Nepal and Bhutan, gift or donation, going abroad for employment, emigration, which means leaving one's own country to settle in another country, or in simple terms, moving abroad. Maintenance of close relatives abroad. Travel for business or attending a conference or specialized training, or for meeting expenses, for meeting medical expenses or checkups abroad, or for accompanying as attendant to a patient going abroad for medical treatment or checkup. Expenses incurred in connection with medical treatment abroad, studies abroad, or any other current account transaction which is not covered under the definition of current account in FEMA. It is also good to note that the AD bank may undertake the remittance transactions without RBI's permission for all residual current account transactions which are not prohibited or restricted transactions as amended or defined in FEMA Act or rules. It is for the AD to satisfy themselves about the genuineness of the transactions. Another question that comes to mind could be, can remittances be made only in US dollars? Well, the remittances can be made in any freely convertible foreign currency. The amount remitted must not exceed an amount equivalent to 250,000, which is 2,50,000 US dollars during the financial year. Now let's understand what are the requirements to be complied with by the remitter. The question that might come to mind is that whether the AD is required to check permissibility of remittances based on the nature of transaction or allow the same based on the remitter's declaration. The answer is that AD is the authorized bank, authorized dealer bank, will be guided by the nature of transaction as declared by the remitter in Form A2 and will thereafter certify that the remittance is in conformity with the instructions issued by the RBI. However, the ultimate responsibility is of the remitter to ensure compliance to the extant FEMA rules and regulations. As I explained in my previous video, the individual will have to designate a branch of an AD bank, where AD stands for authorized dealer, which are authorized by the Reserve Bank to deal in foreign exchange for specified purposes. The applicant will have to submit all the details pertaining to the nature of transaction in Form A2 to the AD bank. So friends, now it's time to wrap up this video. To know more about other schemes for making foreign remittances like $1 million scheme and other FAQs on foreign remittances, you can watch my next video, which will hopefully come up soon. You can also watch my other videos where I have shared information about tax benefits for returning NRIs like RNOR tax status and other tax benefits for NRIs on sale of property in India, and many other videos related to financial planning and investments too, which are not only relevant for NRIs but for all others as well. I hope you all will benefit with the information shared in this video, and if you find this information useful, then please make sure you click on the like icon and please do subscribe right now if you haven't done that yet. You just need to log in with your email ID on YouTube to subscribe. That's it. It's totally free for all. So do it right now. Subscribe, like and share. Share it with your family and friends, and do share it in the WhatsApp groups in your phones as well. Thank you and bye-bye.